you can see that all that's happened has been that the Fed funds futures going out through, through the summer of next year have came dropping off quite nicely, very nicely, in fact. This obviously goes out to back end of 2024. So this is out to August of next year. So as we go out into August of next year, you can see we're looking at a 450, 475 basis point target range. 450, 475 target range against the current Fed funds future of 530, of course, means that we're looking at somewhere around about 2 to 3 rate drops between now and the back end of summer next year. It's not a lot, but it's better than nothing, I suppose. Is it correct that that's happening? Well, we can see that the drop off in the Fed funds futures seems to be massively correlated to this drop off in oil prices, doesn't it? Seems almost as if it's the same line. Kind of strange, that, isn't it? But we can also see that more importantly for us, not necessarily with the oil, but more importantly for us, is that the 5-year linkers market, which is the black line, agrees entirely with this move. It was a little bit hesitant about doing it, and then you can see it dropped off big style when the new contract roll came in for December. So obviously it was just rolling contracts, and then it obviously changed, and then we've seen the 5-year linkers pretty much now in agreement with the Fed funds futures, allowing us to read that oil price seems reasonable. Now, we've obviously seen a little divergence at the bottom edges here on oil. Opportunities for buyers to at least explore the possibility of getting long oil onto their books makes a bit of sense, doesn't it? Makes a bit of sense. Now, when it comes to oil and we look at calendar spreads, it's important that we understand what the calendar shows us. The big macro, of course, on the calendar is crazy important. We've highlighted this crazy importance to you guys on many occasions. Now, we can't really get much from the 5-second chart or the 5-minute chart. We really have to get up into the bigger narratives. And, when we get into the bigger narratives, one of the key aspects to the bigger narratives is we start looking for changes. When does it go negative, for example? When can we start seeing net supply coming into the oil price in terms of those supply-demand dynamics? And let's take a look. Well, we know on a macro chart basis that when we go below the zero, on a macro chart, when we go below zero, we move into a supply-led market, yes or no? Yeah, right. And we can see we go below zero here. Now, we've been below zero before. We've tested the zeros here. We've tested the zeros here. So when we look at when we've tested the zeros, we're now looking at a market that has that genuine feeling of supply coming in, because every time we came off that, we never really made any progression against the next high. So when we come into these areas here and we can see these supply-driven market narratives here, we're now getting a very strong sense that we should be selling pullbacks. Selling pullbacks is a good idea at this stage. So if we look at that narrative going back to the middle of November, and we ask that macro-sized question, well, what price was oil back in the middle of November? We can see that if we look at oil at that stage, we can see that change to supply came in from that drop off of $76.24. So we can basically almost draw a line across the charts at that stage. And pretty much we're now looking at that as our supply-demand area, aren't we? Kind of ties in with every contract change. You can see it ties in with this drop here, and it ties in with that drop there. $76.80. Well, today it's trading $68, $10,000 per contract lower. Interesting? Sure. Data coming out, guys, in just under a minute. Just under a minute now for the data on the oil.